Hi everybody. I wanted to go over one more time the homework questions we did in class yesterday and just wanted to go over one more time the lecture, the lesson plan we did together and go over some of the concepts regarding consolidation subsequent to the date of acquisition. So one more time talking about this first problem we did with Jensen acquiring all the common stock of Miriam. The question is asking, what is the investment in Miriam Co. at the end of 2013? So we're going here from the beginning of 2012 to the end of 2013, and just wanted you to see what is happening to the investment account as they're making the investment. So initial investment is 257,000 that we're putting in here, and that's just because that is how much Jensen invested into Miriam. Now you look at Miriam here, and you're talking about what is the income that Jensen is picking up from Miriam, and this is going to be these items right here. We have this is the income that's coming in because that is what's the subsidiary making in these 2 years of operation in 2012 and 2013. Now we see that Miriam also paid a dividend each year, $10,000 each year. So we know to put this, and dividend reduces the investment amount. Keep that in mind. In the equity method, dividend reduces the investment account. If we're going to use the initial value method, keep in mind that dividend is actually something that's considered income. Now, we're talking about amortization. This is something that we know reduces the investment account using the equity method. So we have a negative 19,000 here, negative 19,000 here, and that reduces our investment account. I know we did it in class, just wanted to see, make sure you get the method and the detail behind every piece, and the answer is going to be 286,000, and that's going to be the final. Now I want to move on to question 2. We didn't do this one in class, but I just wanted to go over the books of Kale Corp, and they paid 1.02 million to acquire Caltop, and this is the information for Caltop, and we're talking about 2012 now has gone by, and Caltop earned 126,000 and paid dividends of 48,000 during the year. What is the amortization regarding 2012? So in this question, we're talking about Kale acquiring Caltop and now trying to do their books for the year end and trying to maintain their investment account. So we're talking about, the question is just what is the amortization allocation? So for this, we want to look at the assets, book value, and fair value. So we have building at 240,000 versus the fair value of 268. Right? And then we have equipment of 540 versus equipment of 516, right? And now, let's see here. And useful life is actually given here, 20 and 10. And so we can see what will be the amortization, right? What will be the annual amortization on this guy? And you can see that we'd have to see the difference first and divide it by the useful life. And as we do that, we see that we're actually seeing an amortization of 1,400, 1,400 of the expense on the building. So every year, I actually have to amortize the building by 1,400 more, right? And for equipment, we're actually paying less than the book value. We're getting an amortization credit. In other words, we've been over amortizing it. Now we have to reverse some of that of 2,400, which is a negative expense, which is actually a positive number. So as you see here, in total, this is actually providing us with an increased income. In other words, a negative expense that would be an increased income in the amount of 1,000. So So that's something that we're working with here. Right? Now moving on to the next question. Same exact data with still with Kale and Caltop, and the question is asking what is the balance in Kale's investment in subsidiary account at the end of 2012. So same exact data, but just saying what is the amount of the investment account at the end of the year. Now the first question is, what method are they using? And they're using the equity method, right? So using the equity method, the investment is going to be 1,020,000 to start with, right? And then the question is saying what was the income. So we see income was, let's see, 126 for the year. That will come over, and dividends was 48, so that would be reducing the investment account. And the amortization we can grab from the last question, right? So it is negative 1,000. In other words, I would say that this is actually going to increase the investment account because it's a negative adjustment. So this is going to be, an all in all, 1,099,000 as the update to the investment account, including all these items using the equity method. And primarily the thing here is that we started with an investment, added the income, backed out the dividend, and ordinarily this would be a minus for the amortization, but keep in mind that this was actually, since the equipment was actually paid less than it is being over amortized, and we must actually reduce that expense because it should be being the base of this depreciation base should be 516, not 540. We're over depreciating, and we need to actually reduce that expense by providing this credit of 2,400, and since we have a debit of 1,400, the net amortization adjustment is a positive 1,000, increases income, and as you see here, it actually does increase the investment account as well.